Did you know that your life insurance can pay you while you're still alive? And if you're not leveraging permanent life insurance to build wealth, then you are missing a huge opportunity to secure your financial freedom. So stick around, because in this video, I'm about to show you exactly how to use your policy to create your own personal bank. And so if you are new to me or to the channel, my name is Katrice, and I am a licensed health and life insurance broker and paralegal. And I help entrepreneurial women to grow, protect, and secure their finances using a comprehensive, personalized strategy based upon their financial goals and risk tolerance. Okay? And so if you are enjoying the content, then go ahead and subscribe so that you never miss when I post new content to the channel. Okay? And so if you've ever wondered or thought about how permanent life insurance works beyond just offering a death benefit, then you're in the right place. Because today I'm diving deep into the cash value aspect, how it grows, how it benefits you, and how you can tap into it when you need it. Now, whether you are new to life insurance or you are looking to get more out of your current policy, I've got you covered. So get your notebook and something to write with so that you can take notes. Now, before I get started, if you would like to learn how to calculate how much life insurance you need to be properly covered, then grab my free ebook that teaches you exactly how, and the link is in the description. All right, so let's break this down, okay? So the first thing we're going to talk about is your premium structure, okay? How your payments are allocated. So when you pay your premiums into your life insurance policy, the insurer divides your premium payment into distinct components. The first is the cost of insurance, or it's also called mortality charges. And so this is the portion of the death benefit coverage that pays for the death benefit coverage and the risk that the insurer assumes, okay, on your behalf. And then there are the administrative fees and expenses, which covers the operating costs, policy management, underwriting commissions, and administrative support. And then there's the cash value contribution. And so this portion is remaining after covering all of the above costs accumulates within your policy, and this is what creates your cash value. Okay, so how does it work over time? So in the early years of the policy, a significant portion of your premium covers the insurance costs and the administrative fees, resulting in slower cash value accumulation. And then in the later years of the policy, the internal costs start to decrease, and a larger portion of the premium contributes directly to building cash value, causing a steady increase in your accumulated cash. Okay, so this is why when you take out a permanent policy, whether it be whole life or universal life, you have to let it sit and grow and continue to grow over time so that the cash value grows. And you also want to, and you're also taking advantage of the compound interest, okay? And so now permanent life insurance, it comes in different forms, and each having unique approaches to cash value growth, okay? So the first is whole life, which is traditional whole life that everyone knows about. And now whole life offers you guaranteed cash value, okay? And so the insurance company typically guarantees a minimum interest rate, ensuring a steady, predictable accumulation. And it may pay policy dividends based on insurer performance, potentially accelerating your growth. Now, dividends are not guaranteed, and so if you want a policy that does have participating dividends, then you need to make sure that you state that up front when you are looking for a whole life policy. Okay. Now, then the next is universal life. Okay, and universal life provides flexibility in premiums and death benefit amounts. It earns cash value. Earns interest at rates set by the insurer, usually aligned to the current market rates. Now, the interest rates do fluctuate based on broader economic conditions, which can influence the growth positively or negatively. Okay, and then there's index universal life. Now, with the universal life typically goes off of the money markets. And then you have the index universal life, which this links the cash value growth to the performance of a financial index, such as the S&P 500 or the Barclays. Okay, now they usually offer protection against market downturns, so you have a floor, okay, alongside caps on upside gains, balancing risk and growth potential. So say, for example, you have an index universal life, and the floor may be at 0, meaning that if there is a negative downturn that year, you wouldn't lose anything, but you also wouldn't gain. Okay. However, if there's an upswing that year, then you may be capped at 12%. So if the market gains 15, you might only get 12. Okay, which 12% gain in a year is great. Okay. And then lastly is the variable life insurance. Okay. Now, in order to get variable life, you do need to work with somebody that does have their security license. But variable life allows cash value investment in selected sub accounts. So these are similar to mutual funds, and it offers the greatest potential returns and highest risk. Now, the cash value does fluctuate based on market conditions, and they technically are more risky because they don't offer that floor protection. Okay, if the market has a downturn and loses, you lose as well. Okay, all right. So the magic behind cash value growth is primarily the compound interest and cash tax deferral. Okay, this is where the magic happens within having a permanent policy. Okay, so the way compound interest works is interest is earned on the policy's cash value, is reinvested back into the account. Okay, so instead of you taking the interest stays in the account and it compounds. Okay, and so each year new interest accumulates not only on your original principal but also on previously earned interest, compounding continuously. Okay, and this steady compounding creates exponential growth over decades, dramatically increasing the policy's value over long-term horizons. Okay, now when it comes to the taxing of the policy, the growth of your policy's cash value is tax deferred, meaning that you don't pay annual taxes on the interest or the dividends accumulating within the policy, allowing for uninterrupted compounding. Now, withdrawals up to your total premiums paid are usually tax-free, as they are considered a return on your initial investment. And so only amounts beyond your original investment, which would be your gains, may be taxable upon withdrawal. Okay, so now let's talk about policy loans and withdrawals. This is how you can utilize the cash value. Okay, so the accumulated cash value can be utilized in various ways, serving as a flexible financial asset. Okay, So first, we're going to talk about the loans, policy loans. Okay. So when you take out a policy loan, there is no credit check. There's no qualifications required. And so this gives you immediate access to your funds. Okay. Now, insurers usually offer lower interest rates compared to traditional loans. However, loans accrue interest that if that interest is not paid, it increases the outstanding loan balance. So it's the same as a regular loan. It's just that the interest is a hell of a lot lower than what you would get at your local bank. Okay. There is no mandatory repayment schedule, which is great, because if you go to your bank and there is a mandatory repayment schedule, normally 30 days after you receive the loan, they want you to start repayment. Okay. And so policyholders can repay on their timeline or not repay at all. However, failure to repay does reduce your death benefit. Okay. And it does have an impact on the death benefit, because any unpaid loan interest plus any unpaid loan plus interest is deducted from the death benefit upon death, potentially reducing benefits significantly if unmanaged. Okay. And so when you are looking at your policy, okay, and you have significant cash value and you are wanting to take out a loan, I recommend to all of my clients that if you take out a loan, that's great, that's fine, it's your money, you can. However, you want to pay back the first loan before you go and take out another loan. Okay. Now, if you choose not to, you don't have to, but just depending upon how much cash value you have and how large the death benefit is, then that should help determine how you whether or not you want to pay back the loan or not. Okay. Now, withdrawals. Okay. Withdrawals allow direct access to your cash value, subject to policy limitations and fees, and withdrawals permanently reduce your cash value and may lower the death benefit proportionately. Okay. Now, personally, I recommend loans to my clients, just because when you take out a loan, then you can pay it back. Once you withdraw, that's it. There, you don't pay it back, and it reduces how much capital you have to tap into at a later time. Okay. All right. So what happens if you no longer need the policy? When you no longer need the policy, then you can surrender it for the accumulated cash value. Okay. And so the surrender value is the insurer's return on the total cash value minus any surrender charges or unpaid loans. And so any cash received in excess of the total premiums paid is considered taxable income. Careful planning helps to mitigate tax liabilities during a policy surrender. I don't tell people not to surrender their policy if they no longer need it. However, I advise people to think about why you got the policy in the first place. And if you got it to pass down wealth, generational wealth, I don't recommend surrendering the policy, because honestly, you can never have, this is just my thought process, but you can never have too much money to leave to your heirs, especially when it comes to life insurance, because you're passing it down tax free. Okay. So while you may have other assets like real estate and stocks and bonds and things, all of that can be subject to capital gains taxes, versus life insurance, which, because it's passed down tax free, it skirts that capital gains tax. Okay. All right, so let's talk about dividends, which this dividends you find in traditional whole life insurance. Okay, so mutual insurers often issue dividends representing a share of the company's profits. Okay, so dividends are not guaranteed, but strong performing mutual insurers have stable dividend histories. Okay, and so with dividends, if you have a policy that participates in dividends, you can choose to use the dividends to purchase additional insurance. So you can increase your coverage and cash value with it. You can use it to reduce your future premium obligations. You can allow the dividends to accumulate interest, compounding growth, or you can receive the dividends directly as income. Okay, so you have quite a few options when it comes to utilizing the dividends in a traditional whole life policy. Okay, now it is critical to recognize the expenses inherent in permanent life policies. Okay, permanent life policies cost a lot more to have and maintain than a term policy, because one term is only is only going to provide you with a death benefit. Okay, and then it's only going to provide you with that death benefit for a certain amount of time. Okay, and once that term has expired, then you no longer have the coverage. Okay, so the mortality costs, and these increase as policyholders age, potentially consuming cash value in the later years if the policy's premiums are not adequately funded. Okay, so if you get of age and you have a significant amount of cash value and you stop paying your premiums, they will take the premiums out of your cash value. Okay, so it will really eat up your cash value. Okay, also the administrative fees, the policy management commissions, and operational expenses are deducted regularly from premiums. Okay, and then there's also the surrender charges. So any early withdrawals or policy cancellations often incur substantial fees, significantly impacting cash accumulation in the early policy years. Okay, and so careful premium structuring and proactive management can minimize the negative impact of fees. This is particularly important when it comes to the universal and index universal life policies. They must be structured properly, because if not, the cost of insurance will eat up at the cost value, and the policy can balloon, and then it won't function properly. Okay, and so let's talk about several external and internal factors that can significantly influence how effectively your policy accumulates its cash value. So the first thing is the interest rates and economic environment. And so the lower interest rates it may slow the cash value growth, while the higher rates accelerate it. Okay. You also want to look at the insurer's financial performance and make sure that they have strong financial stability, and performance allows for the insurers to pay higher dividends if they pay dividends, which improves your cash values growth. Okay. You also want to pay attention to your investment choices if you are looking at a variable policy, because the performance of underlying investment sub-accounts directly impacts your cash value, demanding careful risk assessment. So you have to be really careful when you are choosing your who you're going to invest in with your variable policies. Okay, and then your behavior obviously directly affects the policy as well. So you must be consistent in your premium payments, be strategic in your dividend usage, and responsible borrowing behaviors maximizes the long-term growth potential. So if you really don't need to access the cash value, just allow it to sit and accumulate. Now, if you take out a policy, say for your children's college education, then you definitely want to make sure that you're not trying to tap into that before they get into the age where they're in college and you need to tap into it. So you want to let it accumulate as much as possible. The easiest way, the best way to do this would to be to take out the policy when they are young as possible, because the rates they're normally like dirt cheap when they're, like if you get it while they're 1-2 years old, they're normally dirt cheap, and those rates are locked in for their normally like up to like 21. And then as they are growing, the policy is aging, it is growing the cash value that you can then tap into when it's time for them to go to college. Okay. All right. So beyond death benefits, permanent life insurance cash value provides versatile financial tools used in broader financial planning. So you can use it to supplement your retirement funds. I was just talking about college funding. You can use it to help fund your children's education through policy loans or withdrawals without affecting the traditional financial aid calculations. It does, when it comes to estate planning, it can help to facilitate the wealth transfer by providing liquidity for estate taxes or inheritance equalization among heirs. Okay, and so when you have the policy, you designate the beneficiaries and how much of the death benefit you want them to receive, so you can, get multiple policies and one for each child. You can get multiple, you can have 1 to 2 policies and designate a percentage depending upon how many children you have. So you have a lot more flexibility in how you can pass that money on to your children after you are no longer here. And then you can also use it for to tap in for emergency funds, and it can easily provide access to cash in times of a financial emergency without all of the restrictions of a traditional loan. Okay. All right. And so just to summarize everything about the cash value, the premium payments are split between the death benefit coverage, the administrative costs, and the cash value accumulation. And the cash value growth depends on the policy type. So whole life is guaranteed. Universal life is market influenced. Index universal life is index linked. And variable life is investment based. Okay. Now, the compounded interest and tax deferred accumulation enhances the growth potential significantly. And the cash value is accessible through loans and withdrawals, each with unique implications. Dividends, which are for whole life, can substantially enhance the growth when reinvested. There's fees, expenses, and market conditions that will significantly affect your policy's performance. And everything truly is based upon the policyholder, which is you, your behavior, such as your premium payment discipline and responsible use of policy loans, which is critical for optimizing the growth of the policy. Okay. And so when you truly understand how permanent life insurance builds its cash value, it puts you in a very powerful position, because you are not just investing in coverage for your loved ones, but you're strategically cultivating a financial tool with lifelong benefits. And so over time, this cash value can become an essential asset to you, providing tax advantage growth, accessible funds for emergencies, supplemental retirement income, or even legacy wealth planning, or all of the above. Okay. And so remember that permanent life insurance is not just a policy, it is a long-term partnership with your financial goals. And so when you use this wisely, it can empower you to leverage your policy's value, navigate life's uncertainties confidently, and secure lasting financial freedom for yourself and your family. All right. And so if you have made it this far, thank you for watching. My goal is to provide practical, actionable financial advice to help you take control of your future. And so now, if you found value and this video helped you, please do give it a thumbs up and share it out with someone who needs this info. Okay. If you have any comments regarding cash value, how it works, how you can get a policy, put the questions in the comments. You can also book a life insurance consultation with me. The link is in the description. And if you have any questions about how to choose how much life insurance you need to purchase, I have my free ebook that goes all over this, teaches you how you choose how much life insurance you need. The link to that is in the description as well. Okay. And so remember, the way to secure your financial future is to protect it now, because no one is coming to save you. All right. So have a good one.